Hello everyone. So today we are going to discuss about another well discussed ratio, which is price to book ratio. So again, as usual, the price to book ratio I am going to discuss here will be completely different from what you have as an understanding about price to book ratio. So let's get into it. So before discussing about book value, let's discuss what is equity share capital. So equity share capital is nothing but the face value into number of shares, or otherwise called number of shares outstanding. So the quantity of shares the company has floated out, so that is called shares outstanding. So this equity share capital is also called simply equity capital as well. There is no change in the face value until and unless the stock is going for a split as a part of its corporate action to bring in more liquidity into the stock. So face value remains the same. So face value into number of shares outstanding, you got the equity share capital. So now coming back to book value. So book value, otherwise called shareholders equity, is nothing but the total assets minus the total liabilities. So this is basically book value or shareholders equity. Now this shareholders equity we can further decode in between the difference between total assets to total liabilities as equity share capital, which we already discussed as face value into number of shares outstanding. This is nothing but the money raised by the company by issuing its shares outside through an IPO. Even though they would have got much higher value than a face value of a share. Say for an example, if a stock is having a face value of 2 per share, the issue price would have been 300 or something. So if you see an IPO listing, price would be much higher than what the face value be. But as per the accounting practice, in the balance sheet of the company, still the equity share capital is mentioned in terms of the face value. Hope that is clear. Equity share capital, that's one part of the book value. In addition to that, you have the retained earnings, which is nothing but you have profit after tax from the company business, which is shown in the balance sheet. A part of that earnings is going into the book value of the company and retained there as retained earnings. Then next comes the reserves and surplus. So these are nothing but money kept aside for specific purposes like capital reserves. End of the day, book value is nothing but shareholders equity, which is again broken down into 3 components. One is equity share capital, another is retained earnings, and the third one is reserves and surplus. Now this accounts for the book value of the company. Now if you see various apps like your screener or in value research or in money control, all those things, what you will see is simplified version of this, which mainly will include share capital plus reserves. That's it. And sometimes it is mentioned as share capital and other equity. So other equity includes the retained earnings along with reserves and surplus. So now that you know technically or theoretically what the book value is, now let's get directly into the practical application of it. So now that I have told that book value is the difference between the total assets minus the total liabilities. So the assets mainly include property, plant, equipment, inventory, cash and cash equivalents, and investments. So these all things you will get in the balance sheet of a financial statement of a company. Other thing is the total liabilities. So what is total liabilities? This includes mainly the borrowings, which is known as debt. It can be short or long-term debt. Then the taxes. Then account payable. So this is nothing but the total liabilities. So the difference between these two, you will get the shareholders equity, otherwise called book value. Now let's get into the dark side of this book value. So everybody talks about the price to book value. You should look at price to book value, price to earnings. So price to earnings we already discussed in the last video. So price to book value, if it is very low, if it is below 1.5, it is below 2, 3, then it is highly undervalued. It is the price is very near to the book values. You can buy it, just close your eyes and just buy it, and it will fetch you multiple returns. It will become a multi-bagger. All these things are very well in the industry. To some extent it is right, but there are a lot of hidden things in a book value. So let's dissect it stage by stage. First thing, if you see price to book value, this book value actually includes the intangible assets as well, especially in case of companies like TCS and all, wherein you can see on my screen, you can see they have mentioned in the assets the goodwill and also other intangible assets. So what is a goodwill? So these things are not physically measurable, just like a plant, equipment. These all things in a manufacturing industry, it's clearly understandable because it's a physical thing. You can see that a real estate, a property, everything you can see. But if you see goodwill and other intangible assets, or intangible assets are things which cannot be seen or measured physically, unlike a tangible assets like a property or a land or a machinery. What is this goodwill? So say a company, even TCS, is acquiring a lot of small businesses, right? So if they are acquiring a business who is doing a engineering service to a particular firm, so they have their own employee, their own brand, their own customer base. Like if an order comes, the order will only come to this company. So such will things are there, which is not physically measurable, but it's a goodwill thing. So while TCS is acquiring that company, the tangible assets of that company is say 50 crore, but TCS paid 80 crore for acquiring that company. So that 30 crore, which is nothing but the difference between the purchase price and the real assets, is called the goodwill. So why that goodwill? Again, as I told, that particular firm would have their own customer base, their own brand value, their own employee relationship with various customers. All these things you cannot physically quantify. So these are invisible things but required for doing a good business. So these things are valued under goodwill, and TCS pays extra 30 crore as a goodwill. So this 30 crore directly comes into the balance sheet of TCS as goodwill, as you have seen in the screenshot wherein the balance sheet of the TCS is shown. And again, if you see the other intangible assets, like TCS has mentioned in the balance sheet, they have mentioned in the notes that it is rights under license agreement and software, other software licenses. So these all things, there will be companies who is hiring TCS services and using softwares and license agreements or some patents of TCS, and they are supposed to pay royalty and other things to the TCS, and it is generating revenue for TCS. So these are non-measurable things. So this will be basically categorized under the intangible assets. So other intangible assets include intellectual property, patents, customer loyalty, R&D, brand equity, trademarks, copyrights, licensing rights, as we have seen in TCS case. So all these things. So nothing can be physically measured, but it is there, which has to be accounted. So many of the companies mention this, many of the companies don't absorb this properly, but actually it should have been added into the book value so that the book value will become bigger in actual and the price to book value will go down. But in contradiction, if you see Warren Buffett's, I'll just play a clip here.
Not book value. Book value is not a factor we consider. Future earnings are a factor we consider. And
we've tried to put in the annual report pretty much how we approach securities, and book value is not a consideration, virtually not a consideration at all. The best businesses, by definition, are going to be businesses that earn very high returns on capital employed over time. So by nature, if we want to own good businesses, we're going to own things that have relatively little capital employed compared to our purchase price. That would not have been Ben Graham's approach. But Ben was not working with very large sums of money, and he would not have argued with this approach. He just would have said his was easier. And it is easier, perhaps, when you're working with small amounts of money. My friend Walter Schloss has hewed much more toward the kind of securities that Ben would have selected, but he's worked with smaller amounts of money. He has an absolutely sensational record, and it's not surprising to me at all. I mean, when Walter left Graham, though, I would have expected him to do well. But I don't look at the primary message from our standpoint of Graham really as being in anything to do with formulas. In other words, there's three important aspects to it. One is your attitude toward the stock market. That's covered in Chapter 8 of The Intelligent Investor. I mean, if you've got that attitude toward the market, you start ahead of 99% of all people who are operating in the market, so you have an enormous advantage. Second principle is the margin of safety. which again gives you an enormous edge and actually has applicability far beyond just the investment world. And then the third is just looking at stocks as businesses, which gives you an entirely different view than most people that are in the market. And with those three sort of philosophical benchmarks, the exact evaluation technique you use is not really that important, because you're not going to go way off the track, whether you use Walter's approach or Walter Schloss's or mine or whatever. Phil Carre has a slightly different approach, but it's got those three cornerstones to it, I will guarantee, and believe me, he's done very well.
So as per Warren Buffett and Charlie Munger, they don't believe in book value, is what they are telling. Though I have some difference of opinion, being a core value investor, but let's leave that. So he's telling that you should not look at the book value, but you should look at the earnings power of the company. It is partially, I agree to that. So again, I would like to quote two sentences from two books here. One from the Intelligent Investor and second from the Security Analysis. So I'll just directly read it for you. So this is Intelligent Investor. So in this, I'll just read out: the net asset value, book value, balance sheet value, and the tangible asset value are all synonyms for net worth, or the total value of company's physical and financial assets minus all its liabilities. It can be calculated using balance sheets in a company's annual and quarterly reports from total shareholders' equity, subtract all soft assets such as goodwill, trademarks, and other intangibles. Divide by the fully diluted number of shares outstanding to arrive at the book value per share. So that's what is mentioned in Benjamin Graham's Intelligent Investor. So they are telling that all the intangible assets should be subtracted while deriving the book value, which is in total disagreement while you see the, say, companies like TCS or other software companies wherein their intangible assets, they are also accounting that in their book value. Now let's get into security analysis. This is again by Benjamin Graham. Benjamin Graham is father of value investing, again kind of guru of Warren Buffett in his early stages of investing. So let's see what it is mentioned in that. So basically the clause which I have read in Intelligent Investor book is chapter 8. You can note if you want. And this is chapter 42 of security analysis, wherein it is mentioned that the book value of a stock is the value of the assets applicable thereto as shown in the balance sheet. It is customary to restrict this value to tangible assets, that is to eliminate from calculation such items as goodwill, trade names, patents, franchises, leaseholds. The book value is also referred to as asset value and sometimes as tangible asset value, to make clear that intangibles are not included. So in security analysis also they are mentioning this, that intangible assets should not be accounted. But unfortunately this is not the practice which is followed by many of the companies, and if you really want to calculate that, then you will have to delete these assets and then find out the book value, then take the ratio of price, the current market price to the book value, so that you get the real price to book value, which may look inflated because you have taken out all the goodwill out of it. But for software companies, the goodwill is something, or the asset light companies, less capital intensive businesses, the goodwill is something which is important to be considered. Otherwise your price to book value will be highly inflated. But me as a value investor, or we as a value investor, we should actually not consider such non-measurable intangible assets, so that your valuations are correctly done. So if you see, what are the possible manipulations which can be done while calculating a book value? Now we already spoke about goodwill and intangible assets, but if you see, as Warren Buffett was also telling, book value often ignores the future growth potential or the future earnings potential of that stock. For an example, semiconductor business. So currently they are setting up their high capex fab factories in various locations, say in Gujarat. So say Keynes India company, they are putting up their plant in Gujarat. So while putting up, there will be a very high cash burn and capex plan of thousands of crores will go to that plant, and they will not generate any sensible profit and or even revenue. So they may not create a profitability in their balance sheet for say next 2 years. So they have a cash burn, they don't have an asset. So the same thing won't be reflecting in the book value. But if you see the future earnings power, once they set up the plant, then they will have a lot of production, they will cut imports, the government PLI schemes and DLI schemes and other schemes which I mentioned in the earlier semiconductor video. So that will promote their profitability and also ease of doing business, which will create great wealth for the company going forward. So that is not reflecting in the current book value. So price to book value may look so much inflated because people have priced in the semiconductor business. They keep buying the stock without looking at the valuation. So book value remains small and the price becomes bigger. So price to book value looks very big. Another thing is depreciation and amortization. So we had already mentioned that in our YouTube community post, wherein depreciation is for a physical asset and amortization is for a intangible assets like goodwill, wherein the value of that is depreciated over a period of its serving period. So depreciation, a plant is having 10 years of operation and a machine is having a 10 years of life and it is bought at the first year, and the total cost of purchase is divided among the 10 years of its lifetime and it keeps depreciating. But if you see, even if it is depreciating, it is not that after 10 years you will not be able to use that machine. You can revamp it, you can do some small corrections or some maintenance in that machine and you can reuse it. So even though the depreciation is acting in and it is depreciating the book value, it is not actually reducing in book value in real terms. So is with the amortization, wherein the intangible assets are depreciated over a period, but that may not be the real case. Also property and assets, if you see the as per accounting practice, if you see DMart, which is having very high price to book ratio, even price to earnings is I cannot tell, it is above 100, so that's different case totally. But if you see, as far as the price to book is concerned, the book value what they are calculating is based on, say, if you see DMart buys properties and the majority of the properties is bought by them, and then the land is bought by them, and then they build the retail store there. So the buying price 10 years before would be say 10 crore for that 50 cents or 1 acre property. After 10 years, it will not be 10 crore. It would have become say 50 crore or 60 crore. So still in the book value as per accounting practice, it is mentioned at 10 crore only as far as the plant and property is concerned. So the acquisition price only is mentioned there. But the inflationary impacts and the appreciation over the years is not accounted in that. So actually the asset value of DMart maybe as far as the land is concerned is much, say 5 to 10 times higher than what it is mentioned. So actually the price to book value would have been lesser. But as per accounting practice, unfortunately, it is not to be accounted and hence the price to book value may seem bigger. So there can be another mismatch in the book value wherein there can be some unaccountable liabilities which is not actually absorbed in the liability section of the balance sheet. Say some legal fights is going on. If the legal fight is the company loses, then he'll have to pay a huge sum. So that is actually a liability. Some companies mention it as provisions, future provisions, but some companies may not, and it may not show in the liability, and the book value will look inflated because it is nothing but the difference between assets minus liability. So liabilities is shown less from actual reality, so the book value may look inflated. Also another environmental clearance charges, etc., which is actually liabilities, may not be shown in the book value and the book value may seem inflated. Also companies can inflate the book value by buying back the shares, because book value per share is nothing but the book value, total book value, the shareholders equity divided by the number of shares. So the number of shares can be reduced by buying back the shares. So if you buy back the share, then the number of shares reduces, number of outstanding share reduces, and the book value per share may look inflated. So if the company is really having good cash generation from profits generated from the various businesses and then they are using that to buy back the share, then it is actually a good value addition. But if company is arranging money from various debts and liabilities and then buying back the share. So that is not a correct way because it is basically artificially inflating the book value and the valuations may look incorrect. Also, if you see, a low price to book value is not to be considered as cheap always. It may not be a bargain always, because if you see, the low price to book value may be due to poor earnings, deteriorating asset value. So based on this, the investors would have accounted it and the price keeps falling and the earnings is also falling. Book value may be the same, but the price is going down in a faster pace. The numerator is going down and the denominator is kind of same. So price to book value may look very small, but it is because of some fundamental issue in the company. So that is why I always tell that price to book value should be seen in conjunction with other valuation metrics, especially ROE, return on equity.
And earnings are what determine value, not book value. Book value is not a factor we consider. Future earnings are a factor we consider. And as we mentioned earlier this morning, earnings have been poor for a great many Japanese companies. Now, if you think that the return on equity of Japanese business is going to increase dramatically, then you're going to make a lot of money. I mean, and you're correct, you're going to make a lot of money in Japanese stocks, but the return on equity for Japanese businesses has been quite low, and that makes a low price to book ratio very, very appropriate because earnings are measured against book. And if a company's earning 5% on book value, I don't want to buy it at book value if I think it's going to keep earning 5% on book value. So a low price book ratio means nothing to us. It does not intrigue us. In fact, if anything, we are less likely to look at something that sells at a low relationship to book than something that sells at a high relationship to book, because the chances are we're looking at a poor business in the first case and a good business in the second case.
So return on equity is nothing but the total profit after tax divided by the shareholders' equity. So shareholders' equity, already you know, it is book value. So if you convert that into the per share basis, PAT is nothing but PAT divided by shares outstanding, which is nothing but earnings per share. So EPS divided by, again, shareholders equity per share basis, it is book value, so book value per share. So EPS divided by book value will give you the ROE, return on equity. So this both you divide into 100, you will get the percentage ROE. So if the ROE is very high, say above 15%, and your book value is attractive, then it is a good buy as far as the stock is concerned. But if the book value is very low, say below 2 or something, but your return on equity is just 2-3% or 5% or below 10%, it may not be a bargain buy. Because if you see, ROE is nothing but earnings per share to book value. So whatever assets they have, the company is utilizing that assets to generate profit. So it shows the efficiency of the company to generate profit from those assets. So that is ROE. If the company has lot of assets but is not generating sensible profit, then the ROE will be very low, which shows that the business is not good, at least for that period of time. You should not see ROE for a particular period, particular year. You should look for a period. So is the book value, so is the price to book value. So if for a period the ROE is continuously diminishing or it is poor, then you may not consider that as a bargain, even if the price to book value is low. So return ratios also should be looked in conjunction to the price to book value while evaluating a company for undervaluation. Sometimes you will be lucky wherein you will get a low price to book value and a high ROE, and because of some macro functions or overall market crash, you may get that company. Such a stock was Nava Limited, which I had bought a few years back, which has become now 7-8 times. So it is all about picking the stock at the correct time, having some patience for the valuations to be correct, but also not emotionally getting carried away just by your price to book ratio. You have to look other ratios as well in conjunction, and you should see all these manipulations and hidden things in price to book value. Otherwise, you should not hear the media wherein they tell that the price to earnings and price to book is very low, just go and buy it. So that is not the way of buying a stock. So for an example, if you see Maharashtra Seamless, the price to book value as I speak is something around 1.5 and their ROE is 16.6%. So it is company which is undervalued with a high return on equity. So this can be something which you can look at, further research and understand. None of the stocks which I am mentioning here is a recommendation. You have to do your own due diligence, but I am explaining you the valuation process, wherein how deep you should get into the valuations and understand the stock. If you see again TCS, they have considered all the intangible assets and their price to book value is something around 17 as I speak. But if you see their ROE is above 50%. So they are utilizing their assets properly, though their price to book value is overcooked. Anyhow, the stock is overcooked for sure as far as TCS is concerned, but I am just taking an example for you to understand practical application of evaluating a stock valuation. Another company is Sangvi Movers, which I had picked very long back. Their price to book is 3.5. They have become a multi-bagger, more than 10 times it has become in last few years. And their ROE, if you see, it is above 18%. So this is how companies generate profit by utilizing their assets properly. If you see another company, Manali Petrochemical, their price to book value is as low as 1.3%. Undervalued, right? But if you see their ROE is below 2%. Below 2%. So there may be some small issues like raw material cost going high, some one-time issues or something. I'm not getting into the stock specifics, but you have to look into all the valuations and just should not look at the lower price to book value and invest in the company. That's the whole point of it. So hope you have understood about this valuation ratio, well discussed valuation ratio in the media, but you should not get carried away with such wrong information and you should do your own due diligence and analysis like this. If you have any observations or comments or doubts, you please feel free to comment in the below comment box. See you in next video. Till then, happy investing.